Welcome to Punch Card Investing, a weekly show dedicated to all things value investing. Whether it be analyzing companies, pitching ideas, or discussing moves by the best investors in the world, we're trying to get one step closer to punching an investment off of our cards. Let's get started.
Hey everybody, welcome back to the Punch Card Investing Podcast Show Experience. My name is Jack Duffley. As always, I'm joined by Investing with Tom, with Frank, and of course I'm Jason Rothman, aka the After Dinner Investor, taking on the hosting duties tonight. Frank, Tom, it's fantastic to be back. It's fantastic to be joining you guys here on this Friday night U.S. time. I think Saturday morning. I'm going to say afternoon for Frank with his beer, and it's good to see you guys. And it's exciting to be the host tonight. Going to be talking about a lot of special things, but let's start off with some special guys. By the way, for Jack out there, there's links in the description. You guys can go check those out, and good things will happen. But how are you guys doing? Go ahead. Let's start off with Frank. Bad host. What a bad host. Frank, how are you doing?
Yeah, I'm doing pretty good. Keeping it quiet. Not too much happening. A few interesting companies coming onto the radar. I think the state of the market is an interesting one, and there's more opportunities than ever. I think if you look at that little Value Investors Club pie chart, it's finally starting to say there's some opportunities. So I'm liking what I see.
I'm feeling the same. Tom, you've been busy. You just waiting back for some opportunities. Overall, how's it going?
Yeah, good. I'm actually feeling a little under the weather this week, so that's why I may sound a little funny, possibly. But I punched a card off the old punch card, 20 holes thing this week, and I was looking back through my transactions for 2022, and I think that's the first new stock for the year, other than my single Berkshire B share to go to the shareholder meeting. So, yeah, exciting week.
So you bought Carvana?
We can talk about that later. Okay.
Just to give the people a little preview, Tom, are we going to get a name out of you tonight, or?
Yeah,
or
sure.
No?
Why not? I'll tell you it's not Carvana, and then maybe we'll see how we go.
Thank God for that.
Okay. Well, later in the episode, we're going to be talking about Carvana. The people want an update on it, and if I can't convince you to buy it, and you are going to hold on to this position for more than 2 days, which is sometimes not as long as I hold on to them, which we'll talk about with Continental, we'll get your name. So I'm going to write down Tom's investment. So yeah, guys, hey, it's a very choppy market out there. The S&P 500's down. It had a good day today, but it's down 20% or so this year. I actually looked it up this week. Since 1940, just to give everyone some context in terms of what kind of market we're in and how historical this year is, and potentially how much of an opportunity it is. The S&P 500 since 1940, which is 82 years, I believe, has only been down more than 20% in a year, 3 times. This would be the 4th time in 82 years. So that just shows how choppy of a market is. And one thing I've noticed is as the market gets choppier, I am looking for wonderful businesses to buy at a great price and hold on to. But I also find myself focused on wanting to get alpha and wanting to get performance. And I'm drawn to these special situations like Seritage, like Activision Blizzard, which we'll talk about, because if they work out, you potentially have annualized returns of 30, 40, maybe a lot more percentage that you can rack up as the market's overall in a choppy environment. So let me start off with you, Frank. Just overall, the market overall, being in a down market, maybe for the first time in your investing career here, where the market overall is going down, what's that done to your thinking on investing? Has it changed the way you think about investing? Are you looking at different opportunities than you would be throughout 2021? Has the market influenced you at all this year?
I don't think it's overall changed my investment style or approach, but the types of opportunities that are coming up are certainly different. I think, like you said, special situations kind of start to appear more in a market like this. The long-term compounders don't seem as interesting right now because the growth is pretty unpredictable. It's harder to forecast 20% annual earnings per share growth on some large cap that people probably were comfortable doing the past 5 to 10 years. So I think people start to move towards some of the deep value and special situations, which are the opportunities I'm definitely starting to see more of. Not that I'm making too many bets. I think I've been pretty quiet relative to the opportunities I'm seeing, but there's a lot more companies on the radar, which is exciting.
Tom, what about you? Are you looking at businesses differently in 2022 than you did in 2020 and 2021?
I think no is the short answer. I mean, I've added to a few different stocks that were already sitting in my portfolio, and I guess there are some things that have changed. Like, we recorded a podcast earlier this week, and we're talking about the whole, situation maybe 12 months ago, when a lot of us were getting interested in Chinese tech stocks, and we were sort of saying, at that time, that was like one of the only areas that was kind of interesting. The rest of the market didn't seem that interesting, but there is a lot more out there. It seems like. So,
Yeah,
overall, feeling pretty good about that.
I would say the one thing it's done for me is like I have been buying Alphabet, wonderful business. I think at a more than fair price. But you look at these kind of long-term growers out there, and honestly, I kind of think to myself, like, is this thing really going to do anything in the next like year or so, or is it just potentially going to be even lower in a few months? I know that's maybe not the correct way to think, but I am thinking that way. And then what it's done for me is it's made things like Seritage and Activision Blizzard, where you can, if it goes well, you can lock up that 30-40% gain. Maybe it's only 20-25%, but that seems like so much more attractive to me now in a down market, an almost sure thing, than it did in 2021. So that's what I've noticed for myself. But if we're going to start off here with Seritage, have you guys been following the news? I guess I'll throw it to you, Tom. You can kind of break the news to everyone. It's in the filings, but no one seems to care.
Yeah, you're talking about the news that just came out this week.
Yeah, the news that came out, it was in the proxy, and that they're going to be, I guess it wasn't this week. I guess it was many months ago at this point, back in July. They come out with the proxy and they say, hey, we think after paying off the debt, as we dissolve this company and sell off the real estate, we think we're going to get $18.50 a share to $29 a share. And we think we're going to get that for you within 18 to 30 months. And the stock popped and it went up 100% within like a week. Now, interestingly, since then, it's been down with the market overall. And I'm going to pull up Seritage here. From a high of 14 on August 12th, it's down 25% to 1050. And just recently, about a week ago, it was at $8.31. And so, Tom, news came out this week where they're kind of not walking back that valuation estimate, but they've kind of updated on the likelihood of getting a certain amount. Do you have those numbers?
Yeah, I have we got some news on property sales this week. Is that what you're referring to?
No, yeah, let me go through the numbers and we'll go through property sales. So they come out recently and they say, hey, given what's going on with the market, and I thought this was very important, given what we're seeing with offers that we're getting for some of our real estate, we no longer think the top half of that $18.50 to $29 range is likely. So they say the bottom half is what they think is likely, and that's $18.50 a share to $23 or $23.50 a share. But again, potentially getting that back within 18 to 30 months, you run the annualized numbers on that. And when it was down at $8, that was like a 30 to 100% annualized return, depending on the timeline. So I've been drawn to it. I actually am back in Seritage as of this week with the 5% position. But Tom, it sounds like they're active selling real estate.
Yeah, sure. So I think the filing you were referring to just then came out 14th of September, it looks like. So a little over a month ago now, where they sort of revised that range a little bit. And then, on the 17th of this month, 17th of October, we got a bit of an update about property sales. And I believe the shareholder vote / annual meeting is actually next
October 24th.
Monday, US time. But in the update we got a few new numbers here. So it says during the period March 30th, 2022 through October 13th, 2022, the company sold 45 properties in joint venture interests, generating $410 million in gross proceeds. They gave some details around cap rates and so on as part of that. They also said as of October 13th, the company had assets under contract for sale for total anticipated gross proceeds of $400 million. Yeah, and there's a few other numbers we could maybe go through later on. But I mean, the point is that they're generating cash from these property sales pretty quickly and before this vote even goes through. And it looks like they're going to clear a pretty good amount of the debt. They've got, it was initially $800 million in debt due mid next year. They've paid off some of that already, but that's kind of the first big debt payment that I guess is a bit of like a liquidity threat to Seritage, and it looks like they should comfortably, hopefully, have enough cash to pay that off now.
Correct me if I'm wrong, but kind of the broad strokes is my recollection is they had something like $1.4 to $1.6 billion of debt due to Berkshire Hathaway. And they renegotiated that and they came out and said, hey, if we can pay it down to $800 million by the summer of 2023, you'll extend the last $800 million or whatever's left to like 2025. And this recent, is that ballpark correct?
That's right. Yeah.
Yeah. So this recent filing came out and said, hey, we've sold real estate. Hey, we have more real estate under sale, and we have even more real estate in our pipeline that we believe is going to be sold soon. And when I added up those numbers, it seemed like we were getting to that 800 million debt level in terms of paying that down pretty safely, in my opinion. And if they can do that and extend whatever's left on the debt due to like 2025, you know, I feel pretty good about it. They also have a CFO that just did this with Luby's, John Gorelli, and he's a specialist at liquidating real estate. And again, if you run the numbers at $8 a share, and it's a little worse at $10 a share, but if you get paid out $18.50 to $23 or $23.50 in the next 18 to 30 months, you're going to get a pretty good return. So Frank, I think you've kind of been like me, where guys like Tom and Brad have really gone deep with Seritage and kind of been active in it the whole way throughout this process. I've kind of danced in and out. I'm not sure if you have, but does this special situation kind of becoming real here pique your interest? Where are you at with Seritage right now?
The liquidation was the first thing that started to interest me again. I don't think enough to actually be interested in buying it, but to start following at least. I think there's too many moving parts that I don't like about the Seritage situation. I'm not convinced they definitely get to $18 per share, and if they do take that bottom end, I'm not sure of the time frame. So the returns might not be as attractive as some people seem to think. I'm not saying they won't be, but just my kind of certainty and conviction around that I find hard to sit with. But yeah, I don't know. I understand why people are interested in the situation, just probably not for me.
Yeah, I think I'm like mostly in your camp, but you know, I went over that 50-yard line and I was ready to initiate a position again. And I think for me, I didn't do a large position because there are a lot of unknowns and it is kind of scary. And it's almost like we're walking into a wave here because who knows what's going to happen with interest rates, but it does seem at least somewhat likely that they're going to continue to be raised. At some point, you get worried about the commercial real estate market not doing too hot and Seritage could have problems offloading that real estate. But you look at the history of their relations with Berkshire Hathaway, and they seem to me to be a pretty friendly lender. And again, I have confidence in this John Gorelli guy. But I want to wrap Seritage up here with just a question to you, Tom. We were texting this week, and when I say me and Tom text, I send about 5 texts, and then he sends 1 text, and then I send 5 more, then he sends.
I just do a thumbs up react. I don't reply.
Yeah, and it's always when I ask him a question too, he still gives me the thumbs up. But hey, it's an honor to just be able to text your number here. You mentioned something this week that everybody's a long-term Seritage holder until 2 years go by, or something like that. And I think you were making the point. I hope I'm not speaking out of school here, but I think you were making the point that, like, yeah, Jason, this is the story that was playing out the whole time. and I've been in the stock. I've been in it at $5 a share. I've been in it at $18 a share, $20 a share. But this is the story, and a lot of people have maybe lost conviction along the way. So I guess my question is that what you meant? And like, how have you held your conviction? Because it seems like it's going to pay off here, Tom.
Well, the story's changed. I mean, it was like a redevelopment story, and we're going to get cash flow in real estate, in a few years'
That's
time.
true.
And the price relative to that cash flow looks cheap, but you always had the underlying theme of like a lot more net asset value than the price, assuming that our liquidation value estimates and that sort of thing were correct. So I don't know. Everyone calls himself a long-term investor, and I don't know, if you ask people like the longest they've owned an individual stock, the answer is somewhat underwhelming usually. So that's all I meant by that. And maybe just one final bit with some of the numbers on Seritage that came out recently. So the Berkshire debt is now down to 1.27 billion, which implies they still need to pay about 470 million of that 800.
And if you look earlier in that filing, and you look at the real estate that's under contract for sale and the real estate in the pipeline, it seems like they clear that by a large way.
Yeah. So there's it implies about 470 million due next year. And yeah, like you say, earlier in the filing, it said, additionally, the company has accepted offers and is currently negotiating definitive purchase and sale agreements on assets with offers of approximately 670 million. So they're kind of over that threshold now, which is good.
Right. And then we can extend what's left on the debt to 2025 if need be, which it probably will be. And then we can get some nice offers for that real estate. I'll just finish Seritage up here and kind of just let you guys know that I looked into the history of Luby's. It's a great, I say Luby's like it's Apple or Google or something, like you guys would know. But Luby's is it's an American tradition that went bankrupt and or is out of business now.
Is that an American tradition?
Well, I was seeing those parallels, but we'll bounce back. But Luby's it was an American tradition. It was like this cafeteria family style environment where it's like for a really good price you could go sit down at a restaurant, but they had like a buffet and you could get Jell-O and fried chicken and all that kind of stuff. And I went there as a kid, and they had a bunch of real estate. And I don't think they went bankrupt. I think they just decided to liquidate the real estate and close down the business or sell the names, whatever. But this guy, John Gorelli, was brought in as the CEO of Luby's as they were winding down. And they communicated to the market in late 2021, and they said, hey, we think we're going to get you $5 a share. And I added up the dividends and what it ended up being by the time they finished up in 2022, and it was like $4.50 a share. So I just thought it was impressive that they pretty much delivered on what they told shareholders they were going to get. So I thought that was a good sign for Seritage. And then one more thing about Seritage, I just thought it was interesting that they say they had trouble selling the company outright. They're still looking to do that if a good offer comes along, but they talked to like 20 other companies or something like that, and no one made them an offer that they wanted to accept for the whole business, because I think there's some crown jewels inside of Seritage, but there's also a lot of real estate that no one really cares about, or different kinds of investors care about the different kinds of real estate. And I think that's why they're having to sell it off kind of one asset at a time or a few assets at a time. But October 24th, shareholders, hopefully we're going to give them, the company, the management, the right to basically sell it any way they can, one at a time, groups at a time, or the company outright. And then they don't have to come back to shareholders for a vote. That's my understanding. One final thing that's weird, this vote on October 24th, if it goes through and management's allowed to kind of sell the company as they please, I think that could be a little bit of a catalyst and the stock might pop. But one weird thing about the filing, if I read it correctly, it requires a 2/3 vote, not a majority vote, a 2/3 vote. And I thought that was interesting. Yeah. Do you know anything about that, Tom? Or I had not seen that before.
Yeah, I know that it's 2/3. I don't know the reasoning behind that.
Yeah, it's weird. And let me ask you, and we'll wrap up here. But as a Seritage shareholder, do you hope that fellow shareholders vote to allow management to sell off the assets on October 24th to give them that right to do it?
Oh, yeah. I mean, that's what I voted for. So I'll leave it at that.
Okay, guys. Well, let's talk about something. Well, hey, Matt, Thank you. I learned from the best. Learned from Jack. So, um, let's talk about something that's maybe in some people's eyes potentially a little bit safer. Um, I see. I turned Matt around there, and shortly in 5 minutes, and
Who's controlling the comments here? Is that you, Frank?
No,
yeah,
that's me.
surprisingly, it's Frank. I was going to say I could turn around Matt here in 5 minutes, but I've been working on Frank for about 2.5 years, and still don't know what side he's on. Every time I bring up Carvana on Twitter, I get some interesting tweets from the lone wolf over there. But let's talk about something that's potentially a little bit safer. And let me ask you a bold question. Start with you, Frank. Activision Blizzard selling for about $75 a share. Microsoft is going to buy it for $95 a share. Hopefully the deal goes through around the summer of 2023. Frank, do you think Activision Blizzard is a safer investment than Seritage?
Safer, yeah, sure.
Yeah.
What's the exact spread percentage wise? Save me doing the maths. Do you know that?
In terms of like 75 on 95?
Yeah, what's that?
Yeah, so that's $20 on 75. I think it's like a 26% difference, or it could go up by 26%.
Yeah.
So that's gone. I remember it was seen around 19% or so. Was there a reason that spread's actually gotten larger? Is that right?
Apparently, there's rumors out there, and that's what I heard on another podcast this week. I don't know.
Yeah, I mean, Buffett, for context, was buying right around 80 or maybe a little bit below 80, and it's down to 72, 73 now.
Yeah. But yeah, it is an interesting situation. I do like in the sense that I think Activision's a great company regardless of what happens here. I think it's probably sitting around fair value at least without doing the actual analysis behind it, just as a rough feel of what I know. So I think the downside's pretty safe. Like if the deal fails, then maybe slightly overpay for the company, but I don't think that's the end of the world. There's no huge downside in my mind.
Yeah.
And then I guess on the upside, it is more appealing because I think there's a court date coming up, maybe November. I think I saw back in the comments that kind of says whether this deal goes ahead or not. So the time frame on that 20% return is pretty appealing, I guess. So if all goes well, then you see the share price shoot up. So I think it makes it an interesting special situation. I just haven't followed it closely enough to actually make a bet on it, I guess. Is that when you're invested in, Jason, or just when you're following?
As of this week, I'm invested in it. Another 5 or so percent position. I got in there with Activision Blizzard. We'll talk about the funds I found to make these special situation investments later in the show. But Tom, as a Seritage shareholder, when you look at something like Activision Blizzard, does it look safer to you as well?
Yeah, I mean, it's a slightly different situation. Like one's a buyout and one's one didn't used to be a liquidation, but it now is. Yeah, I don't really know how to answer that question. I'm clearly more interested in Seritage than I am in Activision. I mean, the reason for that is basically if I were to do some sort of workout, as Buffett calls it, I guess you've got to stack up the different outcomes and the likely returns with each outcome. So the return you'd get in a buyout is pretty straightforward maths, but the downside is harder to calculate. And I don't know that I fully can wrap my head around Activision's business. Like I wouldn't really know what I was left with if I was a long-term shareholder. I do know that either Ted and or Todd was buying Activision before this news came out. So to me, I've always kind of had the theory that Buffett wouldn't be all that concerned if the deal fell over and he just became a long-term owner of Activision. But that's speculation on my part.
Yeah, I think any merger arbitrage kind of situation, you need to be comfortable with the deal not going ahead, which I think is probably a fair call to make with Activision. There's a lot of other deals where you have to be a legal expert to, I guess, know what a decision is going to be to take advantage of something that has a big downside. I don't think this has a big downside. Obviously, they had the problems with management and everything else, but the company and the branding and the IP that's left over seems appealing at least.
Yeah, I'm not a gamer. Sorry, people in the comments talking about Call of Duty. So
Well, you mentioned what you're left with if the deal does not go through. Uh, you're left with Call of Duty, but you're also left with $6.5 billion. I don't know if you guys have an edit button, but they have. My point is they have net cash of like $6 billion, which helps the deal. I mean, helps make it feel a little safer. Market cap is like 58 billion, so like about 10% of their market cap is in cash, but we're not talking cash before debt. We're talking net cash. That's pretty cool. Another thing I was reading this week is that, and I was just reading this, so I think it's correct here. If the deal does not go through for whatever reason, apparently Microsoft owes a couple $1 billion of cash to Activision Blizzard. So you have that kind of sweetening the deal as well. And then for me, the thing that kind of pushed me over the edge here were two things. Number one, SC mentioned it, if you want to pull that up, Frank, the most recent comment. But he says that the internal rate of return on Activision Blizzard is interesting enough to look at. And SC, of course, always comments on the rates of return. Anytime I bring up one of my many 100-baggers, he comments, oh, well, that's only 12% over a gazillion years. But SC is very focused on the rates. But what's interesting is if this deal goes through in June of 2023, when I believe it's supposed to close, which is about 8 months from now, you pull out a compound interest calculator, you put in $75, you get $95 back 8 months later, 2/3 of a year, whatever. And the annualized rate of return is like 40%. And again, I'm sitting here in a market that's down 20%, and I see not a sure thing, but possibly a likely thing that could get you a 40% annualized return. It's pretty attractive. The other thing that kind of pushed me over the edge to go into it is just a pure Buffett shameless clone. And then on top of that, I looked at the quarter that they first bought Activision Blizzard when it was Ted or Todd, before there was any announcement of a merger and a buyout acquisition offer. And we are just about 30% higher than the low during that quarter. And so my threshold for cloning is not buying something for more than 30% higher, or it's not a hard rule, but that's kind of my threshold that I look at. And we're just about 30% higher than the low during that quarter. So that was pretty cool as well. So yeah, that's the situation with Activision Blizzard. And one final thing I'll add, I was speaking to someone who is not American this week about this situation, and I was giving them my take on the political system in the United States and the way Microsoft masterfully navigates that, and how big I think Microsoft is a partner to like the U.S. military and intelligence agencies and all that. I've just been very impressed with the way Microsoft navigates Washington, the way they navigate being one of the biggest companies on planet Earth, one of the most successful companies on planet Earth. And I think they do a really good job of like flying under the radar, of making both sides in Washington happy, being a partner to the United States. And so therefore it would surprise me if they go after Microsoft and say, no, you can't buy this video game company. So I like the political situation as well. And it's just a little opinion there, but that's the situation for Activision Blizzard. When news comes out about something like this, that you guys kind of wrap your head around, but you're not really tempted to buy it right now, do you kind of keep your eyes open that like if the overall market goes down, what if Activision goes down to $60 a share and there's a bigger spread? I'll start with you, Tom. Do you guys kind of keep your eyes open like that?
Yeah, sure. I would definitely get a lot more interested. I guess, again, you still got to understand what you could be left with if the whole thing falls over. But yeah, if the returns look better, I'm definitely more interested. Yeah.
Well, Tom, you're the oil man these days. You took that mantle from me, even though you don't.
I'm definitely not.
Even though you don't own an oil company, but I just want to share a special situation I did with you. I did, and I want to share it with you guys. Company called Continental Resources in Oklahoma City, where I'm from, and billionaire Harold Hamm started the company, and he owned like, I don't know, 83% of the stock, but it's been a public company since like 2008, and the other 17% has floated publicly. And he made an offer a few months ago of $70 a share. And since then, the stock price has floated between like 60 and 70 bucks a share. And the other day it was at $69 a share. And I went ahead and bought it. And the reason I bought it is because I thought it was an asymmetric bet, because on the downside, I get $70 a share and I basically break even, because he definitely has the money to buy it and there's no reason he wasn't going to be able to. And then on the upside, that was a pretty cheap price for that company, in my opinion. And I liked buying that company anyway at $70 a share. And on the upside, I thought maybe they turn him down, the board created a special committee and we get a little more, or someone else comes in, or it just doesn't go through and I get to own Continental at 70. Anyway, within like a couple weeks later, it comes out that they negotiated with him and decided to sell the company at 74 bucks a share instead of 70. I bought at 69. I sold at 74. It's like an 8% gain. It doesn't sound like that much, but it was literally within like 1 to 2 weeks, and it's like an over 100% annualized return. So I just wanted to share that little win with you guys, because it's pretty cool when you start running those annualized numbers. You can get some pretty high rates of return. And another thing, it's like
Jason's a trader now.
Well, I'm a businessman. I bought an oil business, and someone came along and said, "No, I'm going to buy it for you for $5 more a share, and there's nothing I can do about it."
Yeah.
But yeah, I literally, for some of my shares, I bought on a Thursday and sold on a Monday. And by the way, I'm not done on Continental. If for whatever reason the stock, it's going to close in December of this year, by the end of the year, it's at like 73.20 or 25 right now or something like that. If that thing drops down to like 70, 71, 72 bucks, I'm just going to buy more of it, and it's going to go back up to 74, and I'm going to get another annualized return of like 30, 40%. So I'm keeping my eye on it, but I really have been taken into the merger arbitrage, merger workout environment here. And it's funny, just no one cared about it. It wasn't really talked about that much, but it really happened. So Tom, my point is, get into the oil game. We all know you want to.
Yeah, maybe one day.
Okay, so I'm
still on the radar.
I've been out there looking, doing things. Tom's been out there doing something. He punched a hole. We'll talk about it later. But Frank, you were talking about SCS Group before the show. Probably so small that I got my microscope here ready so I can be able to see it, because I know the market cap's probably going to be $700,000 or something. But what's going on with what's going on? And by the way, I'm talking Australian, so we know it's very. I'll stop. SCS Group. What's going on with this company, Frank?
$50 million market cap. So maybe it's probably too small for you to buy, Jason. I know you've got a lot of money floating around, so 50 million probably out of your range. Is that right? Am I accurate there?
Yeah, I got a lot of money floating around, and basically I don't have to worry about paying for food, and I can buy a tortilla anytime I want to. But let's carry on here, Frank. And you don't talk about my money, I won't talk about your money. SCS Group here. So is this company $50 million? Is it in the UK?
It's a UK company, so I think everything in the UK is down a lot more than the rest of the world. I think the FTSE 100 is about 35% down.
Wow.
Year to date, with a lot of macro factors that rightfully justify that market being down. But I think it is creating a lot of different opportunities there. Most of the cheap companies that I'm hearing about, particularly micro caps, are in the UK. So it's a market I've been looking at. But SCS just came up in a Twitter thread from someone I follow only a day or two ago now. And that's Deep Value Situations, if anyone wants to follow him or check out the thread. But he highlighted this company. I think it sounds pretty interesting. It's a $50 million market cap, but the enterprise value is actually zero. They have no debt whatsoever and a pretty good pile of cash. The only debt, I think if you look at something like Ticker, which I might share just to show people, it calculates the leases as part of debt, so you don't get an enterprise value of zero. But obviously they're operating leases, so it's not something I would factor into debt. Some people disagree with that, but I think I'm probably with the large majority in saying you wouldn't factor that into debt. They're not really liable for anything. It's just a lease at the end of the day. So this is a company. They're kind of a well, I don't think I've even said it. It's a furniture company, retailer, flooring and stuff as well. But I think about 90% of their revenue comes from sofas and other furniture. So a pretty boring standard retailer. A lot of retail is cheap again, but this is probably having a zero enterprise value is one of the cheapest out there. It's not really a company that's growing. I'll just pull up the revenue numbers. Is that coming up on the screen there?
Yep.
Yeah.
Just steady revenues besides 2020, where obviously they had a decline like the rest of the market would, being retail. They did start to shift towards some online things that kind of countered some of that decline in revenue. But that online stuff is really only 5 to 10% of the overall revenue still to today. The appealing thing here to me is kind of the payback that you can get here. With this cash pile, the main focus for management is both dividends and a buyback. So they're buying back $7 million worth of shares on a $50 million market cap. So I think that's about 12 or 13% or so you get on a buyback yield. And then their dividend yield is something around 10% as well. And moving forward, that's very likely to continue. They're going to keep producing free cash flow, maybe about 10 million up to 15 million per year, assuming they don't absolutely fall off a rock in revenue. All of their SG and everything remains very flat. So if they continue to just be flat in revenue, which I think they certainly can, obviously it'll slow down a little bit with the state of the market and recession and everything else. But you get this dividend yield of about 10%, maybe a little bit more, and then a buyback yield of 12 to 13%. So you're looking at really a 23-ish percent payback yield moving forward. And this is on a company that has consistent 20% return on invested capital for a very long time. Management that don't seem to want to take on any risk. Obviously, with a big pile of cash in this type of an environment, acquisitions become appealing to some capital allocators, but they've seemed to turn down, from what they've said, a lot of different opportunities to expand beyond what they're doing, keeping it easy. And I think as long as they're returning capital via buybacks and dividends, it's a pretty safe way to make money. I don't own this yet, but it moved quickly towards the top of my watch list after that thread, and then messaging deep value situations on Twitter back and forth. So yeah, it's one that I'm definitely interested in.
Frank, can you give us the quick breakdown on the negative enterprise value, how you get to that? Is it as straightforward as there's no debt and they have a pile of cash, or is there other things to factor in there?
Yeah, so any enterprise value you would see, and if you were screening, would come up with higher than the 50 million market cap. I'll just actually double check what it says on ticker because they probably do it that way. 88 million. So if you're looking at their balance sheet, they have about, I'll get it exactly so I don't misquote this, 70 million in cash and equivalents. And obviously some of that I wouldn't count into it because they probably need to leave some of that cash there in the environment that they're in. So I round that down to 50, so they're going to keep 20 million roughly. They have no long-term debt whatsoever. Of the operating leases that you can see, of the leases that come up on the balance sheet, 90% of those are operating leases. So I discount any of that, and you roughly, give or take, sitting at a zero enterprise value. Yeah, not overly complex. It's just not counting that operating leases that some people would.
Very cool.
So even if you're looking at a PE ratio, you get something like 4 times the earnings roughly, which is cheap as it is. But then again, the enterprise value is zero. So it's even cheaper than that, depending what happens with that cash. It looks like it's just buybacks and dividends. So it's a relatively safe place to be. The downside's pretty protected in my mind.
That's really interesting. Like usually when you get, I can't say I've looked at a lot of these things, but when you get something that's like a negative enterprise value or a net or something like really deep value, usually it's attached to like a business that's just burning cash or they have horrific capital allocation. So to see a profitable business and some buybacks attached to the whole thing is quite interesting.
Yeah, the other interesting side is like the macro environment that they're in. It's going to really hurt their business, but it's going to hurt their competitors even more. The other competitors are going to have debt, almost certainly. They might not be able to access cheap debt anymore, and SES aren't going to need to. They're going to have this cash pile as a safety net, and the environment could create an opportunity for them to kind of take a larger market share and be even better than their competitors that likely will really struggle, and a lot, I think, would go into bankruptcy. So obviously there are real headwinds, so you do have to be careful. They need to make, I think it's around 260 million per year in revenue. Otherwise, they're burning cash. They almost consistently do over 300. So you have to factor in that with a recession, maybe revenues will slow down. Their SG&A or operating expenses in general will stay the same. So you might have some unprofitable quarters here and there, which with the cash pile wouldn't concern me too much as long as it doesn't last for an extended time period.
Nice. It looks like they haven't done, and I don't know if they've expanded their footprint or anything since here, but looks like they haven't done under that 260 million in revenue since like 2014. So
I think COVID, maybe
right?
there was a period in COVID where they were unprofitable. Maybe
Yeah, just a little bit under 255 in COVID.
Yeah, so in that 260 is a pretty big estimation. Obviously, there's a range of things that can happen with that cash flow, but yeah, roughly give or take 260 million, and they're pretty safe, or maybe a small bit of cash burn. But again, with that cash pile sitting there, it's not overly concerning.
So, Frank, it sounds like if the enterprise value is zero, that can lower your risk a lot. But with maybe this company and then like all these small cap companies, is management the main risk? But like basically it's just a very small company. If management does something that you don't like, you basically what I get worried about with super small caps is it's not that I can do something about it with my 0.00 whatever percent of like Seritage or Apple or
50%.
Whatever. Well, 58.000 when we combine our time, because we know you own a bunch of Seritage, but I like these bigger companies because I have these other bigger shareholders. Like I just bought into Suncor, and there's an activist company that's invested in them, and I like that. I feel like protected by bigger shareholders sometimes. So, is the risk with a situation like this or other small caps basically management kind of screwing up the situation?
I think with any company, management is a huge risk, whether it's large cap or small cap. I don't think that market cap has anything to do with that. You always want to make sure the capital allocators are doing the right thing. Just speaking on SES management, which again, I'm very early stages of research for this one, but they seem to have some weird agreement where anyone on the board, I think it is, has to own the equal of 1 year's salary worth of shares. So
Wow.
you have some pretty significant shareholders. Again, it's a small company. They might own a few 100,000 each, whatever it is, but relative to the market cap, pretty big stakes. The CEO, I think, owns around 5%, and then you have a few of these funds that own 10% positions. So if management were going to do something really terrible to destroy this capital, I think you would see an activist situation happen pretty quickly. These large shareholders aren't going to let that happen, and you would think that management wouldn't let that happen because they're large shareholders themselves. So management is always important, particularly when there's a lot of cash sitting there and allocation becomes a risk. But I think investors might be somewhat protected by the fact that they're aligned with shareholders.
Frank, I see a very similar name very familiar name on the list of major shareholders here. Someone called Scion Asset Management. Not sure if you guys have ever heard that one before.
I just came across that today, and I was curious whether that's changed or not. Obviously, being an international holding for Burry, it might have disappeared, and we don't know about it yet. But Michael Burry's involved too, so he's a 5% shareholder or so, which helps.
Well, that's interesting. So what are you looking for from here to kind of put it over the edge to make you want to buy it?
I guess I really have to understand the business model properly first. I really haven't dug into the business model. I'm just pretty quantitative at this stage of my research. Now it's understand the business and really what those revenues should look like in a recessionary environment, because that is important. And then again, on management, really knowing that I can trust management and what they're going to do. And hopefully there's some more commentary around these buybacks and dividends moving forward, because that's that payback yield is all I would want to see in an investment like this.
Gotcha. Yeah, I've taken. You mentioned that they're buybacks, and I've had a newfound respect recently for catalysts and the need for a catalyst to kind of make an investment happen, at least in some cases. But in a situation like this, if there's a really maybe not that dynamic company out there that's selling for a PE of 4, one of the things I've learned over the years and learned to ask myself is, well, maybe that's a cheap PE to me, but what's going to make that actually move and make the market re-rate it? And so it sounds like they're potentially working on a catalyst. And if you look at the stock price, it's only like 15% higher than the low during COVID. So it's down quite a bit recently. And you mentioned the FTSE, I guess the 100 biggest stocks on the London Stock Exchange. If you look at that index, I was looking at the other day, since like 2008, it's only up like 70%. And from like the bubble around like 2000, it's like essentially flat. It's only up 3% in like 22 years. So it must be like an interesting market environment over there. But a lot of people want to talk about Carvana. I know Frank doesn't, because when I tweeted out that we're going to be talking about Carvana tonight, he said, I hope not Carvana. And Frank's gonna take a break. And I guess I'll just talk to Tom. But Tom, I mean, everyone's asking me for a Carvana update, and it's so interesting to me because like the stock price in the last 5 days is down 21%. The stock price in the last month is down 47%. They have not reported quarterly earnings yet. I believe they report on like November 2nd or something like that. But CarMax reported, and they had a really rough quarter, and they were down 25% in one day, one of their worst days ever. And Carvana was down on that. And then it's down on this news coming out about the used car market. And I guess prices in the used car market are down. So then people are worried about the paper and the loans in the used car market. But basically, nothing's changed for me. And everyone's asking me, did I sell, blah, blah, blah. No, not at all. I've actually been buying more. And the one thing I'm pointing to is in the second quarter, the used car market, the overall market was down like 14% or so, and Carvana was up like 9%. So Carvana was up when the market was down. And I've just, in terms of like longer term competitive stuff, I've been seeing some CarMax commercials lately, and they're absolutely horrible. And I've been seeing some Carvana commercials, and they're actually great in terms of getting their messaging about they'll go to your house and buy your car from you and make it convenient. That's all the update is. Basically, the stock price is down a ton, but I found that it's a lot of people think just because the stock price is down, something happened, but that doesn't necessarily have to be the case. Another company I'll throw out there that's related to Carvana is a company called Ally Bank, and now we're getting into the oil man's territory. That's how he affords those NetJet flights with that hat, or at least affords the hat, because he reads about banks all the time. And not just to go to sleep at night like I do. But Tom, there's a bank called Ally Bank, and I guess I don't even know if they're a bank or just a lender, whatever, but they're in the car lending space. And they reported, and apparently the market didn't like the way they reported, but they're saying, no, we're actually doing okay. Point is, I want to put this company on everyone's radar because Berkshire bought it in the second quarter, maybe the second and the first quarter, but it's a lot lower than when Berkshire bought it at. And these guys do a ton of share buybacks, and stock price is low, and they're probably going to be buying back a ton of stock. So I just want to put that on your guys' radar. Tom, I know you're into banks a lot these days, but I'll throw it to Frank. Frank, are you tempted by banks at all? Are you interested in them? I've never really had a big interest for them.
I think this might just show that Jason doesn't actually watch the show, because I think both me and Tom have talked about this separately on the show.
Oh, I'm sorry. So yes. The secret bank in Massachusetts that
No.
Okay.
Not that one. Ally specifically. Massachusetts Bank as well. That's coming up, I'm sure. But Ally is one that we've talked about briefly here and there, just with Norbert Lou being a big shareholder as well as Berkshire.
Oh, okay. So Norbert Lou's in it too.
Norbert Lou's in it too. Pretty significant shareholder.
Yeah.
And they're buying back a lot of shares. I think from 2016 is the year I'm remembering at the moment. They've cut their share count in half. I might pull that up just to make sure.
I'm looking at it now, Frank. 467 million shares. I believe it's in millions. 467 million down to 292 million.
SC tells us they're slowing down the buybacks at the moment.
Which might be part of what market.
So I wonder,
market
SC,
didn't
you have
like,
to
I guess.
clarify. Are you calling us the nuts word, or are you calling the management nuts? And I guess we'll show it. Yeah.
Yeah. Is that word complimentary, or is that, I don't know what?
No, it's not.
I mean, quantitatively, like Ally, I've never done a deep dive on the company, but quantitatively, it looks interesting. I've seen, I've seen financial companies with more stable business results and better returns on equity and so on, but it's trading like 0.6 times book or something from what I'm looking at the moment. So,
yeah,
it's interesting. And if the capital allocation's good, it could work out. There's some smart people in there.
I hear these things about like buybacks, and yeah, they are buying back their stock, but then I go to Open Insider and I look at what board members and management are doing personally, and it's all red. I mean, they're not the biggest sales, but it's a lot of consistent selling of this business, which is, I'm always like, why would I buy a business when management is selling? But anyway, brief Carvana and update, and it'll be very interesting to see what happens on the quarterly earnings, because last quarter it was essentially, hey, guess what? We didn't go bankrupt, and the stock went up like 100% very quickly. But now obviously it's not. So Tom, the time has come. 51 minutes into the show here, you punched a card. It's very rare for you to punch a card, and apparently it wasn't Carvana. So what did you buy? What did you buy this week?
It's not that exciting really, and I should caveat this by saying the moves with adding to existing positions have been much more significant than this. But
we know.
Yeah, it's a company I've been looking at for a little while. It's been mentioned a few times here on Punch Card before, and I think it was actually mentioned in a comment not too long ago as well. And it's Hingham Institution for Savings, a little pretty well managed bank.
The secret Massachusetts bank. Is it in Massachusetts?
Yeah. So there you go. I mean, it's a pretty basic investment thesis. Like, it's very well managed. Insiders own a fair chunk of it. I think the father and son, who are like the two main guys managing it, own about 15% of the stock across various trusts and retirement accounts and that sort of thing. I mean, in pretty much all sorts of different business conditions, they've steadily compounded in the teens, and it's down a little bit this year, probably just due to the fact that interest rates have been climbing a little. They describe themselves as like a liability sensitive bank, which basically means that as interest rates go up, they have to pay out more money on their deposits basically immediately than they have to, then they can then kind of recapture on the loan side. Takes a little bit to kind of flow through there. So that'll be a bit of a short-term headwind, but even in their most recent results, like annualized, they're still compounding at like 10% a year, even given that. So yeah, it's a boring little banking business, but that's what the company is.
And Frank, it sounds like you've been aware of this company.
Yeah, I've owned this one for a while, so I've kind of written it down. So Tom's done much better purchasing than I did, but I've actually been adding to this one throughout the year too. So it's a long-term stock I'm pretty happy to hold. Very high quality management, high quality business. They kind of keep things very simple. Banking's not something I understand, but this was the first bank I really dug into, and the fact that they keep their operations very simple makes this bank a little bit more easy to understand than the typical bank. So yeah, it's an interesting business and one that I'm happy to hold for a while.
So do you guys look at banks, and Eunice says boring is good, and I say boring is boring, but when you buy something like this, do you look at it as like a placeholder to try to earn, I don't know, 7 to 15% return a year until you find something more interesting and dynamic and exciting and that could turn into more than this? Or do you actually see yourself holding this for like 20 years?
No, I'll own this for a long time unless something changes significantly with the business or the valuation gets obscene. I mean, I just been pretty conservative. If you're going to own this thing, please do your own work. But just to share the way I'm thinking through it, been reasonably conservative about the return on assets they can generate moving forward, and that type of thing. I can see kind of mid-teens returns, and you don't have to be that optimistic to get into the low 20s with a little tailwind from some multiple expansion as well. So that's kind of where I'm at. I mean, if you put it sort of through like a Berkshire Hathaway lens, for example, so Berkshire trades at 1.3 times book or something at the moment. Buffett has said he'd buy it back at anywhere below or around 1.3 times book, and it generates about a 10% return on equity. Hingham, if I still have the numbers here, which I don't, but Hingham's return on equity has been closer to 15%. And yeah, 10-year medians, 15.5%, and the price to book is 1.4. So you're paying about the same multiple for probably a better quality business if you look at it through a return on equity lens. So obviously, I've got a whole lot of diversification and stuff in Berkshire that you don't have in Hingham. But that's
so that return on equity in the mid-teens or high teens, that basically comes from them taking people's money, paying interest on that, and then taking their deposits and going and making loans where they get a higher interest rate and making money on that spread. That's where their return comes from.
Yeah, exactly. They're just steadily growing the bank, basically. I mean, they have a small equity portfolio as well, which interestingly must be getting pretty close to the 13F reporting threshold now. That's a bit of a gray area. What's a bit of an unknown what's actually in that equity portfolio, but that's a small component also. But yeah.
So why do you
mainly
think
they're just growing the core banking?
Why do I'm assuming 15 to 19% return on equity is an outlier for a bank. So why, and especially over time, why do you think they've been able to be so successful at this banking game?
Yeah, two things will really jump out at you when you look at Hingham. One is like exceptionally good discipline with their loan underwriting. So they have very few loans they write where they don't get paid back is one thing. And they have a very low cost and increasingly low cost operation. So of the kind of net margin they make from interest each year, a smaller and smaller part over the years has gone towards running the operations of the business. So those are two things that will stand out.
Big position, Tom? Small position? How does it compare to Thor? Is it Thorish, or is it?
It's not. No, I think it's actually my smallest position at the moment. But I'm kind of crossing my fingers that it goes down and I can make it more serious.
Well, let's give a shout out to Karan and Brad and Jack for sure. We're missing them tonight, but I'm sure they'll be back soon. And then let's give a shout out to investing in stocks for the long term. And I guess that means more than buying on a Thursday, selling on a Monday. He wants to go to the Punch Card Conference in Omaha. We will all be there. And then Matt Hansen earlier tonight. Thank you for that super chat as well, Matt, as always. I have a confession to make to you guys, and I hope you don't kick me off the show. And I'm gonna change the screen I'm looking at. I'm gonna not look at the comments going forward. Let me first ask you guys: are either of you in Prosus and Alibaba?
You know the answer to that, Jason.
Well, I think you're in Alibaba. I didn't know if it was a holding you still measure in your portfolio, Tom, or if it was a non-material amount after going down so much. Sorry about that. But Tom, you're in Alibaba.
And, I'm in Alibaba, not Prosus, though. I've never been.
Frank, are you in Prosus?
Yeah.
Okay, so
and Tencent directly, right? And Alibaba
directly.
All three.
Mm-hmm.
I sold this week or last week. I sold out of Prosus completely, and Frank's out of here. Frank, why are you mad? He was probably buying my shares from me. Yeah, so it basically comes down to the position size was like 18% of my portfolio, and water coming up to you or whatever, as I said on my podcast, the water had come up to my balls and it was freezing. And I decided to sell it down to 5%. And once it was down to 5%, I was like, what's even the point? I like this other stuff equally as much, like something like Alphabet, and I like these other special situations we talked about. And I am making this generational bet on oil. And so I decided to sell out pretty much because I lost my conviction about the business, and I want to get your guys' thoughts on this. And I'm being genuine here. I read the book about Tencent. I think it's called Influence Empire. And I came to the conclusion that you can call it 20 guys, you can call it one guy, but the government in China basically controls the outcome of every company in that country. And yes, Tencent and Alibaba have been wonderful businesses, but I lost my conviction on my ability to judge if they're going to be wonderful businesses going forward, because the people in charge over there, in my opinion, dictate whether or not a business is going to be a wonderful business. They dictate the business outcome, and I feel uncomfortable with that, and I don't know which way it's going to go. I don't have any way of predicting that. So that's why I got out. Tom, as you mentioned on my podcast when I interviewed you, and that comes out soon, you said, hey, it was a different market environment when you bought in, and now there's many more opportunities. So I think that played a role in my thinking as well. But that's kind of where I'm at with China and Alibaba and Tencent. How does that sit with you guys? What are your thoughts on the current situation as the prices have continued to drop?
Well, one quick question for you, maybe, Jason, and I asked you this the other day, but it'd be cool to get this from you live. I know that you have a few stocks in. Do you actually have it in like a physical container with like your never sell type businesses where you have the wonderful holding checklist, or is that just a mental thing?
I do. It's in a physical.
So,
it was in there. No, it was in there. And the rule is, you go ahead. Sorry.
Yeah. So I mean, this was a never sell type business, and the wonderful business holding checklist, as I understand it, is one, is the business getting better, and two, is the price egregious? I think we'll assume that the price wasn't egregious, so
Correct, yeah.
It probably was to do with is the business getting better component. How do you think through that?
No, it became not a wonderful business to me anymore, because I have no ability to judge if it's going to continue to be a wonderful business. Apple, Alphabet, Amazon, Microsoft, I can judge it with my own opinion here, but like I have confidence that in my ability to judge what those businesses are going to be, the state they're in, and that they're going to continue to be wonderful businesses. And I know what can knock them off and what can't knock them off. But Tencent no longer became a wonderful business to me, or it stopped being a wonderful business, because for whatever reason, it just clicked with me at this point in time. It's not up to them in terms of they're a wonderful business. Their outcomes are not up to them. It's up to 1 to 20 people who run the country. And what are they going to do to Tencent? How much will they let them succeed? I have no idea or any confidence in my ability to judge that. Why that hit me now, I'm not sure. It had to do with reading that book. It had to do with seeing the news out of that country. And then it had to do with seeing other opportunities as well. But yeah, that's the conclusion I came to. And it's kind of like, I don't know, seeing someone in a different light for the first time, and then never being able to kind of see them the way you saw them again. It's uninvestable basically to me right now, that country. And this is coming from a guy with a ton of money in Turkey. So it's just a decision I made. It no longer deserved to be in that tin can, to answer your question, Tom.
A couple of things. Firstly, I'll partly agree with you in the overall market environment. I think you said Tom might have been saying this on your show too, but part of the reason I first invested in China is mostly my investing philosophy revolves around finding inefficiencies in the market. Most of the time that's by looking at small liquid companies. I think most inefficiencies exist there. Occasionally, you have these different markets around the world that become out of favor for whatever reason,
Yeah.
usually justified reasons, but usually short-term reasons. And China at the time was a market like that, which is what made me interested in the first place. And now I think a market like the UK is just as interesting. And a lot of other markets around the world are starting to fall into that category. I think the broader stock market globally is becoming pretty unfavored. So there's more opportunities. So in that sense, I understand why being invested in China isn't as appealing now as it was in 2021, when everywhere else stocks were expensive in 2021, but China was arguably cheap, depending on your outlook on the political situation, I guess. But other than that, nothing has changed, I think, between here and then with the political situation. If anything, it's probably calmed down and seemed to be getting, I'd probably feel more comfortable than I did. There's different moving parts there with energy and things like that and COVID, but overall, there's not too much has changed in China. So I'm curious, weren't you aware of that risk kind of going into China? And what made you change your mind, I guess?
I think it's looking at it, the risk of just being more of a risk, in my opinion, and not so much being a risk anymore, but being reality and kind of seeing that way. And for me, I honestly feel like I made a mistake. Like I feel like I should have known this going in and shouldn't have made the investment. But yeah, I don't have confidence that you can basically as an owner of a business know where your business is going to go. So I guess it's more so coming to the realization and then seeing the risk realized, or at least feeling that way. And then a lot of it is the COVID zero stuff, and it's like that's probably just going to continue to go on and on. Another thing was this third 5-year term that G is getting, and they just had they're having their big meeting. And basically, if I'm reading the tea leaves right, him coming out and saying like, yeah, like, this is the way we do business and you can get used to it. And then just reading that book and kind of, I don't know, just realizing for myself that like, hearing the growth story of Alibaba, hearing the growth story of Tencent, hearing the way these businesses kind of grew up, and then realizing, no, it's not 2014 anymore. It's not 2015 anymore. They're kind of where they are. And then them selling off stocks, like they've had to sell off portions of it seems like they've had to sell off portions of their portfolio, Tencent, to make the regulators happy. And it's like, is that really the best business move? Maybe not. So it's all kind of just, everything's kind of coming together. And again, influenced with, I'm seeing other opportunities. But yeah, I don't see myself being drawn back to that country for a long time. And then finally, not to get political, but like I'm getting the sense it's different. The United States relationship to China versus New Zealand and Australian relationship to China. Maybe it's not, but I mean, we're almost in a Cold War situation here with China, and it doesn't seem to be getting any better. And it just seems like almost a conflict to be an American almost at this point, to be invested there, to speak frankly to you. And I'm being like, we don't have to go too far into it, but there's a lot of things that country's doing to my country that people in my country don't like. And to be invested over there, it just didn't sit well with me anymore. So that's the China situation. What makes that interesting, if we really are in a big conflict with China here, the United States and China, I believe like 25% of GM's revenue comes from China. You think about the supply chain that Apple deals with China. And another thing, Frank, was the Taiwan situation, and wondering what is going to happen to the businesses I own and the stock prices of those businesses when I had an 18% position. If China invades Taiwan and then the world reacts to China's market the way it's reacted to other countries' markets that did stuff like that, I kind of don't want to be sitting there holding that bag, if you will. And it seems like that situation has accelerated the timeline. And I don't know, it doesn't look like it's going in the other direction at all. So it just felt like time to get out.
Yeah, I think the Taiwan situation, it did get a little bit more real, I guess, when some of the news reports surrounding the Taiwan and things, but that risk was kind of always there in my mind too.
It was there, and that's why I'm like, man, I made a mistake in my
and
own for myself.
And to be fair, if they invade Taiwan, I think that's much bigger than a Chinese problem. I think you see the global markets in a lot of trouble if a situation like that starts to happen. So that
Chips.
risk applies. Yeah, that risk applies worldwide, I think. Of course, China get hit the hardest, I guess, but that's a problem for everyone, not just China. And I think the risks, they change as the year goes by. I guess there's always a new risk. Some things seem to fade away, but I think that's where there was a comment that kind of summed up perfectly by SC. He says, I don't think it's uninvestable, but sizing is important. And I think in China or any markets, the UK, I'm kind of starting to think the same way about. You need to be careful with your allocation towards these stocks. I don't diversify my portfolio with the amount of stocks that I own, but I try to do it geographically and within the types of businesses that I own. So that's just one thing to think about. China obviously is one of the more risky markets in the world. I would add Turkey to that list. Obviously, Russia probably tops that list right now. But the UK and stuff are moving towards these same kind of risk moving forward. So allocation is just the main thing in my mind. And it's not too big in my mind that I'm scared to see what happens, I guess.
And Frank, when I see Alphabet in the United States of America with like $100 billion of net cash and like an enterprise value compared to what I think they're going to earn a few years out at like 9 or 10 times their earnings, like, and this huge runway that I see for the next 100 years, like it just makes, why deal with that drama? Why deal with that risk is kind of where I got to. And it was a very interesting situation. I don't know if you guys have had this, but once I got to that feeling and that decision, almost, I could not kind of like persuade myself to hold or stay in there. Like I just had to get out. So I guess we could move the conversation to selling. When you guys think back on some recent sales that you made, have you made sales in the last few years that were not like selling something to go buy something you like better, but selling something where you thought you realized you made a mistake, or where the business got worse in your opinion and you just wanted to get out? Do either of you have any of those experiences in the last couple of years?
Yeah, I mean, I've sold stuff, but it's always been business results focused. Like, I mean, a lot of the we've gotten pretty macro here, but like a lot of the things you've laid out are real risks. I also think like at the time we were buying, and potentially even now, like the prices are down a lot with Alibaba and so on.
Yeah.
I also think you've been compensated for taking those risks, and like SC said, allocation is kind of important when you're making those decisions. The other thing is like once you feel that you're being compensated enough to take on some of those risks, I think it really just comes down to focusing on the business results. So that's all I'm really paying attention to with Alibaba to make a sell decision at this point. I mean, it's tricky because we've had aggressive lockdowns and stuff, and the most recent set of results from my perspective, I made a video on it, weren't that impressive from Alibaba. But again, you can't, like, if you're a business owner and you let's say you manage Alibaba through that period of zero COVID lockdowns and that sort of stuff, you're not going to interpret those results as like a typical quarter. So I think we've got to give it some time before you do anything too rash. Yeah. Well, not to say that your decision was like, if you've got good places for the money, more power to you. But that's how I'm thinking about it at the moment.
I would say this about China. Frank, you mentioned Turkey earlier, and I've heard this from Monish in some of his lectures. He's talked about investing in tough markets that the world is not positive on. And he mentioned something about like the filter to look at Turkey through. Their problem is inflation. So you have to look at businesses that can handle and do well with high inflation. And so you kind of craft a filter that's specific to that country that you're dealing with. And my filter on China is that you have to be in businesses that the CCP is going to support and wants to do well and not going to hurt. And when you look at a lot of their communication about what they want to do in the coming years, I don't know how much like an e-commerce company that sells stuff or like a video game company that gets guys to sit on their couch and become soft. And that's not what China wants. They're limiting the amount of video games people can play, and they've got this manly culture thing that they're pushing. I don't know how these tech companies kind of play a role. I know clouds and AI is a big one, but you think about something like BYD and spreading their electric vehicles all around the world. Something like that seems to be more kind of possibly would be supported and not hurt by the government. And I just don't know if the government there just doesn't like Tencent and Alibaba anymore. But anyway, Frank, what do you think?
I was just going to push back
Yeah.
on that a little bit. I think the CCP is pretty dependent on companies like Alibaba and Tencent doing well. Of course, they want to regulate those as best as possible, but it's not too different to what you've seen with Facebook or Meta in the US over the past few years and not being able to make acquisitions and things like that. And Meta adjusted, and I guess you can argue whether or not they're going to do well here on out. And that's a bit of a different story, but every government's going to regulate these mega cap companies that really affect the economy. But at the same time, they can't afford to destroy them overnight because the effects that would have on the Chinese economy would be pretty big. So I think the Chinese government needs Tencent and Alibaba to be the companies that they are today. And I think Tencent specifically have diversified out of China through their investment portfolio. And a lot of their gaming, and they've even said their gaming acquisitions moving forward or investments are going to be outside of China. They're just global acquisitions mostly moving forward. So that de-risks it slightly. Can't say the same for Alibaba necessarily. They do have some international investments, but yeah, I don't think these companies can be taken away and destroyed overnight. Obviously, there's risks involved, and it is more than the US, but it's not too dissimilar in many ways with the mega caps in the US.
Go ahead, Tom.
Yeah, I was just going to push back before as well. I was going to say, like, something like Alibaba is a platform for people to run small businesses to a significant extent as well, and I think that's pretty. That's well aligned to me for long-term growth. But
I mean, it's okay for us to disagree, and that's what makes this show interesting. But my pushback would be, I literally think 20 guys at the CCP are able to sit around and go, like, screw these Alibaba guys, screw these Tencent guys. Like, we don't want them getting rich and like having too much influence. Like, they're not going to be more than a $400 billion market cap company. They're just not. And if they decide that, they're not going to be. So that would be my my pushback to that. But yeah, it's what we're seeing here between myself and you guys is kind of the overall market and the way the market's playing out. More people are kind of on my side right now because that's why the money's left China and the stock prices are down, and I've joined them. But if you guys are right, then potentially there's going to be very high returns in these businesses. Interesting card that G has to play at any time he wants to. All he has to do is talk about supporting businesses, and they can just move the needle a little bit on these companies and put out some real positive news, and potentially a flood of institutional money will come back in and push these valuations way back up. So anytime they want to pull that card, they can. But I will say, I'm not opposed to going out forever. These stocks are getting so cheap now, and like the discount to NAV at Prosus is so big that I could potentially be tempted to go back in there. So it'll be interesting to see where it goes. But so we don't end on a talk of Cold War and all this kind of stuff. Do you guys have the punch card portfolio pulled up? Are you able to get that? Some people on Twitter are demanding change.
Do you have access, Tom? I don't think I have the login for it. If you just share your screen, I'll pull it up.
Sure. Talk amongst yourselves for a minute or so. We actually have been forgetting to vote on companies. That was the whole thing behind the
I gotta say, as a fan of the show, I like when you guys potentially make moves in there, and I kind of like the survivor aspect of someone being voted off the island, if you will. So I'd like to see some movement there, and I think it's due time based on some of the performance of these not stock prices but businesses.
I've wanted to vote a few off the island for a while now.
Yeah, the punch card portfolio is not doing well, but here we go.
Do you have the year to date as well, Tom?
Sorry, one sec. Hang on. Nearly there. Yeah, I should be able to get the year to date.
And Frank, what was your contribution? It was Kelly Partners.
Yeah, I think mine might be in the green. Hopefully, I don't remember what the price was.
It's definitely carrying the portfolio.
Thanks for reminding the people.
Is that coming through?
What I bought, Jason.
Well, it's something that's been holding up in the portfolio. What was Tom's contribution? Alibaba?
I believe so. I think.
Can you zoom
that is a big China waiting, guys. Speaking of China, that's a lot of China.
Yeah, I think Brad almost didn't put Seritage in. I was going to switch to Seritage, but I believe it was
good.
It was Alibaba. So we are down 38.5%.
Let's
for the end.
Can you zoom in on the positions below, Tom? It's just a little bit far away.
Sure.
So what's been the worst position? Oh my goodness, Turtle Beach. And look at Frank. He's not only got the capital gains, but he's also getting dividends, and he's got to go against currency headwinds, and he's still outperforming the overall market by like over 30%. Well done.
There you go. And if we go year to date, calendar year, where are we at? Down 31 versus down 20 year to date.
Let's scroll down again, Tom. Let's look at the holdings. Baba down 40%. Wow. Prosus down 42%. Wow. You know, a lot of people gave me crapola for race S and inflation and all that kind of stuff. I was looking it up today. I don't know how long it's been. I've been holding it. Maybe it's a year. Maybe it's like 14 months, or maybe it's less than that. But I'm up like 20%, even after the inflation stuff. The turtles died on the beach, down 70%. Turtle Beach is still in there. So what are the mechanics here of this amazing portfolio that you four, I'll say, have constructed, ex Frank here? What do we have to do to get something out of there?
Well, we have
get
to
them
vote
all out of
something.
there.
We have to vote something in as the process. So correct me if I'm wrong, Frank, but I think a majority of us have to vote in a particular stock, which hasn't happened yet since inception. And then I believe we put it to the people for something to get voted out.
So you have to have a 3 out of 5 vote that 3 of you want to put something in there, and then the people vote which one is taken out.
Is that right, Frank? I believe so.
Yeah, 3 of us have to agree. I'm just getting triggered by a comment by Jesse, who says, I think it was Frank or Brad that picked Turtle Beach. Don't ever bring my name into that, Jesse. and it also wasn't Brad, to be fair, to defend Brad's honor. Yeah. It was Jack that picked Turtle Beach.
Yeah.
So I think the first step for you guys to be able to have a vote is all the representatives and senators have to show up to the Capitol. Where are you guys? You got to get 5 for 5 here. The next time you guys get 5 here on the show, you got to vote.
Well, I think Hingham might be due for a vote, Tom.
Yep. I don't know how the other guys are going to react to Hingham. I don't know that any of them have looked at it too closely.
I think we can push at least Crown over the edge. If we just Turtle Beach, man, I just don't know.
It's just sitting in the portfolio.
I feel similar about Seritage, to be honest, but
really,
Seritage will be okay. Seritage will be okay.
Frank, I encourage you to look into Seritage. I mean, we are in it's a headwind of a macro environment here, and it's kind of like a race against the clock, and we offload these assets before things get too ugly in the economy. I think I'm thinking about that correctly, Tom, but there is a race going on. But man, if they can get to the finish line before the economy crashes, like you look at what the annualized returns are sitting here at $10 if you get paid even 15 if it takes 18 months, it's a pretty good return.
Yep. Preaching to the converted.
Yeah. I mean, I'm a big Seritage fan these days, and But yeah, you got to get something in there. I mean, Alphabet's sitting out there. Meta would be a controversial vote if you guys took that.
Yeah, it's hard now too with the. If you still have it open, Tom, could you pull up the diversification of the portfolio? I'd be curious, even if we sold Turtle Beach, it might only be like a 5% position. And then I guess Kelly Partners would be a pretty big position now. So maybe trimming needs to come into the conversation about what to do next. I don't know, because otherwise we're going to end up with a very small position. That's
you could, and you might like this, Frank. You could layer on something here that the vote happens. You guys vote to put something in there. The people vote on what to take away, and then the person who has the best performance to date gets to make a decision with the allocation or something like that.
Can we zoom on that a little bit, Tom? Sorry.
Is that better?
Yeah, that's not too bad. So 7% for Turtle Beach. And then the others are pretty reasonable sized positions still. Yeah, so maybe some kind of trim.
I also don't hate the idea of whoever position gets voted out, I get to take their vote going forward. I'll throw that out there.
Just putting that out there, are you?
Yeah, just putting it out there.
I don't know if we already said this, but we did say the punch card members vote the stock in, but then the fans vote which one comes out.
Yeah, but there's got to be punishment personally to the person that decided to put a Turtle Beach in here.
In lashes.
There's got to be consequences, guys.
You get an arm bar at the punch card conference.
Yeah,
I think it might deserve an episode where we kind of revisit this portfolio.
You do this. You put the person on the spot, the person that stock gets voted out, and they have to talk about why they made the decision and decide in front of the world if they made a mistake or not, or defend their position, defend their honor, as you said earlier, Frank. But speaking of honor, guys, it was an absolute honor to be brought back on the show. And that's a funny comment from Mano. But it's an honor to be brought back on the show. And it was a thrill to be the host tonight and or the moderator. Any parting words from Tom and Frank as we go out to the music here?
Yeah, I was just going to say, well, firstly, thank you everyone for watching. And Jason, yeah, you've been a very good host. I'm completely useless at it. And Frank, sorry, I don't think. Well, I won't say, but I think you're a very good host, Jason. So
thank you. Yeah, appreciate it.
So I appreciate you taking the reins here. It's been fun.
Yeah, it's been a lot of fun, Frank. It's always great to chop it up with you.
It's always good to have a good host in there. Duffley knows how to do the job. I think everyone else struggles a bit, so it's good to have Jason in to do the job for us.
Well, I'm here anytime you guys need me, and what else is also always here is the description. So we encourage you to go down there and do what Jack wants you to do and make him happy and click those links, pay the bills, and smash the like button and share the show. This is a great show. This is a great community that these guys have created. We're all going to get together in Omaha in 2023, and we'll see you next week before that.
And check out the After Dinner Investor, of course, as well.
Yeah, check me out. Let's play some music here.
Thanks for tuning in to Punch Card Investing. The contents of this show should not be used as investment advice or as a recommendation to invest in a particular security. Please consult with a licensed investment advisor if you need investment advice. All investments carry risk and the potential for monetary loss. Thank you, and see you next week.